webinar. And today's topic is very topical, relevant, and required RPT reforms, proposed amendment, and industry impact. Friends, as you are aware that we are organizing program on a very topical subject where industry has issue and they want clarification from the professional as well as the policy maker. But in our webinar on corporate professionals, we always try that we should be reactive, we should be proactive, not the reactive. Proactive means whatever law is in the process of making, if you suggest something to change, it is easy way and regulator can understand and they can do. When you react after the law is made by the regulator and then you make a hue and cry, then it is very, very difficult to change, because once they finalize, they will not change easily and immediately. So today's session is also on the RPT reforms, where SEBI has issued a consultative paper on SEBI LODR regulation, and the proposed aim to strike a balance between robust governance and ease of doing business by introducing a scale-based threshold, relaxing disclosure requirement, clarifying applicability provisions, and streamlining approval process. So this is the aim of the consultative paper. And our object of this webinar is to discuss proposed amendment, put forth and then whatever suggestion will come, whatever issue will emerge today, that we will send it to SEBI that they should include in this. Their rationale we will give. What is the insight which is will affect and it will be potentially impact or implication of this proposed changes, and what SEBI should modify it, the suggestion will give. So the various perspective and suggestions of the participant enumerating at the webinar will be collated and then send it to SEBI for the consideration. Friends, as you are aware that this RPT issue is always in limelight. When we interacted the regulator during our industry standard forum, when they made the RPT standard, that time we found out various reports, various parameters, various suggestions, and various issues which regulator SEBI is encountering. And there was a comment that the maximum manipulation is taking place through the RPT route. So SEBI is always very cautious and always not agreeing on changes easily, making very tough, harsh, and then they want to use RPT violation as a serious violation, RPT compliance as a serious compliance, and they want to make it more stricter. Whatever industry is saying that they have a problem, but this is the view of regulator. Same in Companies Act, because Companies Act is a limited point of view and it is applicable to all companies. But listed companies, SEBI has added so many additional parameters and guidelines for RPT transactions. Industry is always saying that RPT transaction is essential, and the way regulator is suggesting and doing changes, it is too much. Now, after the ISF standard, the disclosure norms has become more robust and more cumbersome for industry point of view. But after the suggestions and then again it has changes. Now what is the final with the industry and whatever SEBI has released it through standard forum. Now it is more robust and better. But even then the compliance and the disclosure are there, and it is company has to follow, and companies are even facing that this is tough. So that's why the one biggest issue which was coming in the discussion, and industry was always saying the threshold limit is very less. This 1 crore threshold limit and 10%, whichever is lower, is less. So that's why that was the point. And when uh, we were discussing in ISF, and fortunately today a 4-person from our panelists, Narayan, KSR, Savitri, myself, we were part of the ISF committee, and we have discussed this point. And that particular time, SEBI has suggested that they are coming out shortly. And this was the issue, that if you are saying that these are the compliance, these are the format you have to follow, then the 1 crore limit is too less. So that's why everybody was asking that a company of 1 lakh crore or company of turnover and company of 100 crore, it cannot be the same. And if you calculate 1 crore, it is too less. So today, the SEBI's consultative paper is about this, and they want to increase threshold. They are giving suggestions on how the threshold will change. So in today's webinar, we will discuss scale-based threshold for material RPT, which is suggested by this, and we will put questions, and on the basis, our expert will tell, yes, this scale is okay or not. Threshold for material RPT undertaken by subsidiaries, that is another point. Relaxation in applicability of RPT industry standard, because industry standard is prescribing certain things. Now, for that, certain relaxation is there, and validity of omnibus approval for RPT granted by shareholders, that is another point. Applicability of RPT provision, and that is all we will discuss. Friends, for this, today we have invited the practitioner, the people, those who are handling this issue. I welcome first Amit Gupta. He is a practicing company secretary, insolvency professional with a strong expertise in corporate compliance and secretarial practices. And Amit is working with so many companies work as a practicing professional. Then we have Dr. K.S. Ravichandran, managing partner KSR, and he's a company secretary and distinguished expert in company law, and he's written book on RPT also and various other things. And every time he is appearing in NCLT and other places. And Ravichandran was the member of the ISF also. So we will definitely get benefit from his expertise. And he's a prolific author and speaker. He has penned down over 1,000 articles and several authoritative books, and he's giving lecture across the country. He's in the part of the various committee. I welcome Ravi along with Amit in this program. Then we have Narayan Shankar, a former executive vice president and company secretary of Mahindra, and he's has been serving for over 24 years since June 2001, a seasoned professional. He was also part of the ISF, and he is also expert in Mahindra. Mahindra has a big company, big subsidiary, big related party transaction is handling, and he was handling. So his experience will also helpful. Then we have Savitri Parikh, over 30 years of corporate experience and company secretary and compliance officer of India's biggest company of Reliance Industry. And they have also multiple companies, multiple things. And she will also handling various related party transactions. And today, Narayan Shankar and Savitri both are from the industry and from the big company. They both will suggest us the changes and what government, the SEBI is suggesting. Is it sufficient? Something more should be there. Then we have Ankit Singhi, head corporate affairs and compliance, corporate professional. Ankit is also handling various companies' work, and his expertise and his deep knowledge is also very important. And Ankit was also instrumental to suggest us various things in RPT standard when we suggested to the SEBI through ISF. So friends, so we have a practitioner also, we have a companies also, we have expert in this area. All people will discuss this issue, and we will try to give the maximum suggestion to SEBI when this proposed amendment on industry impact is what and how we can change. Friends, before starting the session, I will just inform you that we are doing webinar every Friday. Our next webinar on 29th August that is fraud in Indian securities market, patterns, pitfalls, and prevention. And we have invited Mr. G. Mohan Rao. He is the Executive Director SEBI as a chief guest, and then Naveen Sharma, Chief General Manager of SEBI, are working in the investigation division. They will discuss and they will suggest various insider trading, front running, and various other type of frauds which is taking place in pump and dump in the security market. So please join for next Friday. The program for today is that first Ankit will give a presentation on what is the present law and what are the suggestions, and in the same slide he will discuss about some queries, and I will ask all the experts, they will give answer, and then after completing the presentation, then I will open to all the learned speaker, so they can additionally tell that what is missing other than this, which SEBI is asking. So when SEBI is doing changes, so they can modify this. That is a pain point of the industry, and that can be better. The regulator can change. And why I'm saying this? Because what is happening, the Prime Minister has said on 15th August that we want to make India a country of ease of doing business, and industry feels that RPT transactions compliance is burdensome and this is hindrance of the growth. So that's why we will suggest them. So all my panelists, they can jot down all other point, and I will know KSR has to go at 5 o'clock. So in between, when the time will come, KSR will give his point. So he can, KSR, you can note down your point, and before you are going, you can give all your suggestions in one go. So around 4:50, I will give you, I will stop it and give it to you if the presentation is not completed, and you can give your suggestion other than whatever it is in the presentation. So now, Ankit, you please take up this session and start from the point of view that what is SEBI's proposal and what is present and what is the difference and how it will, it is not completing the certain parts. Over to you, Ankit.
Hello.
Yes.
Okay, so good evening, everybody. So I think Sir has already laid down the context of the reason behind introducing this consultation paper. And this consultation paper came as soon as the new standards issued by RSF were also notified by SEBI. And then subsequently this standard came. So we'll go by the proposals one by one. And between the proposals, we have some questions which SEBI has put across for our views. And we'll seek views of our expert panelists as to what they think on those proposals. So, just give me a sec. So if you see the current materiality threshold in case of a main board listed entity is 1,000 crore rupees or 10% of the annual consolidated turnover, whichever is lower. In case of an SME listed entity, if it exceeds 50 crores or 10% of the annual consolidated turnover, whichever is lower. And in case of royalty, if it exceeds 5% of the annual consolidated turnover. The reason why we are discussing the current materiality threshold is because the consultation paper, the very first proposal is to change these materiality threshold, which is also outlined, where industry feels that it is on a lower side comparable to their size turnover. So I think considering what the industry was saying for a so long period, now SEBI has tried to introduce or is trying to introduce a scale-based method of identifying material party transaction, where bases the size and turnover of the company, the specific materiality limit for that specific company will be determined. So they have created three thresholds where the annual consolidated turnover of a listed entity is up to 20,000 crore. Then from 20,000, more than 20,000 to 40,000 crore, and then more than 40,000 crores. So in case the annual consolidated turnover is around 20,000 crores, then 10% straightforward annual consolidated turnover will be the material RPT, no 1,000 crore requirement. So for our 20,000, if we will discuss an example as to how this will appear. Then if it is more than 20,000 and up to 40,000, so 2,000 crores plus 5% in excess of the 20,000. So the turnover which is in excess of 20,000, 5% of that amount plus 2,000 crores, aggregate of both will be the material threshold for those companies. Then companies with more than 40,000 crore turnover, 3,000 crore rupees would be the starting point, plus 2.5% of the annual consolidated turnover beyond 40,000. But this is subject to a maximum limit of 5,000 crores. So we'll see there is an example that they've outlined. So for example, if your annual consolidated turnover is around 30,000 crore, more than 20,000 crore, so it would be 2,000 crore plus 5%. If it is 50,000 crore, 3,000 crore plus 2.5% of the excess 3,250 crore. If it is 1.50 crore, 1,50,000 crore. So if the turnover as per the limit, it is coming as 5,750 crores, but there is an outer limit of 5,000 crore. So in case the threshold limit is going beyond the outer limit, then the outer limit will be there. So for example, if this limit would be 4,950, so then 4,950 would be the limit. Since it is more than 5,000 crore, so the maximum limit is 5,000 crore. So 5,000 crore will be the threshold limit for companies which have turnover more than 40,000 crore rupees. So this is how the material threshold will look like. They have also outlined how this will impact. So taking the top 100 listed entities and determining the kind of, considering the kind of material RPT resolutions they have passed in year 2024-25, they have tried to give a figure that how this will going to impact the number. So like for example, up to 20,000, 24 entities, previously they sought approval for 12 material RPTs, post revision it would be 8. Similarly for 24 entities, it would be 20 previously, now would be 8. Then for 54 entities, previously it was 261, drastically reduced to 104, less than 50%. So this table in a way describes the impact of the proposed norm which SEBI wants for the new materiality related party transaction threshold. So this appears to be benefiting all companies across different brackets in a good number. While definitely it seems to be favoring more with 40,000 or bigger size companies where it will drastically reduce the number. But still for lesser turnover companies, still will have sufficient impact. Like for between 20,000 till 40,000, it's from 20, it is going straight forward to 7. So a more than 50% cut. So post these, so this will be the new threshold for listed entities. It would be a scale-based, main board entities. It would be a scale-based threshold limit, 20,000, 20,000 to 40,000, and then more than 40,000. And then for SME and for royalty, the threshold which are existing would continue to be there. So the first question is that we would be putting for our panelists is that how they foresee this scale-based threshold. Do they prefer the current one, or they would like to suggest any modification to these things? While SEBI has not given any specific method of why, on what basis these thresholds have been defined, but this is how they see basis the approvals that the companies were taking. So I am putting it to all the panelists to share their views. Sir, you can, or Narayan Jankar ji, we can start with you.
Narayan, you can suggest what is
Sure.
your view,
Let
because
me go ahead.
one
Let me
issue.
go first then. Okay. So, Pawan, Ankit, of course, from 1,000 crores, or I'm audible, correct, Ankit?
Yes, sir, you are.
Okay, thank you. So what I'm wanting to tell is from 1,000 crore or 10%, whichever is low, to a scale-based threshold, correct? It is undoubtedly a progressive move from SEBI because scale-based approach is undoubtedly the right way ahead. However, the only one small point which I would like to make over here is whether turnover-based threshold should be the only criteria. Because turnover-based threshold would work for revenue side operation transaction, correct? But there are many other transactions And let me give you the type of transactions which I'm talking about. Why I will also give you turnover is not appropriate for those transactions. And I will also give you which will be the better benchmark for each of these transaction, correct? And there are some transactions where it has to be exposure based also. For example, suppose if you're doing investments, equity, debt, whether it is in a joint venture, subsidiary, investment will alter the capital structure and asset base, correct? It is not going to touch your turnover. So for these type of transaction, it will be percentage of net worth or total asset would be an right materiality benchmark. Similarly, when companies as part of their M&A do asset acquisitions, correct, where assets are acquired, correct, these assets may not generally generate immediate turnover because the turnover is not going to be generated immediately of that, and it is going to take some time, and uh, it it can materially change only the balance sheet. So hence, for asset acquisition, I thought we could suggest that it should be percentage of gross asset or capital employed. For example, if it is vice versa, if it is asset disposal, or we could go ahead for a slum sale or a unit sale, correct? The disposal here again will affect balance sheet or it will affect the business structure. And hence here again, gross asset percentage or segment contribution will be the right yardstick. On the other hand, for finance transactions, if you're going for borrowings, loans, debentures, bonds, correct? This will increase liability. And of course, there is a leverage given to the company and it is not related to sales. Here again, percentage to net worth or debt to equity ratio would be a better yardstick, correct? Similarly, if guarantees are given, guarantee, there is a clear liability that will arise if borrower defaults, correct? And it is irrespective of the turnover, it should be linked in a manner to percentage of net worth or total asset, and guarantee amount as percentage of net worth or asset would be a better criteria. Similarly, will be the case for comfort letters, where if it is going to create contingent obligation or many a times reputational liability, correct? It's not tied to revenue. And borrowings covered similarly like others could be probably percentage to net worth, correct? Similarly, where you're creating security creation, for example, whether it is pledge, mortgage, charge, assets pledged create risk of loss, correct? Independent of sales. So here again, value of asset pledged vis-a-vis the net worth would be a better yardstick, correct? If you are doing M&A transaction, for example, corporate restructuring, M&A, demerger, scheme of arrangement, the impact will be on share capital, assets, liability, and not revenue. Here again, we could probably think of net worth or assets involved. Similarly, if I am doing write-off provisions, if I am a holding company, I will have to even do impairment not only on my assets, but impairment on my investment depending on how the subsidiary is faring, correct? It will be, and if I'm doing an impairment to investment, for example, it's a direct hit to profitability and net worth. Here again, there's no turnover linkage, correct? Here again, probably percentage to net worth or net profits could probably this be a better yardstick. So, and for guarantee comfort letter, as we said, the maximum potential financial obligation or asset value at risk would probably be a better yardstick, correct? So hence, what I'm trying to tell you, the way I gave you this 9-10 examples, we could probably suggest SEBI to consider converging towards a multi-metric transaction-specific framework. That's all from me for this.
Okay.
Sir, but
Yes.
won't that be too many to manage?
Sorry?
And I think it is more similar to the earlier ISF standards, which differentiated between balance sheet transactions and P&L transactions. Then
No,
you were
even
suggesting
currently, Ankit,
a threshold
currently,
also based on the same.
no, currently we use these yardsticks even at the time of window closure. For example, as I told you, if we are doing a transaction, correct, and if it is a transaction of, say, a major investment, I am going to close window for the company only if it is going to be material in terms of net worth of assets, correct? I'm not going to link it to turnover. Similarly, the way you said about Reg 30 also, correct, which you are making a mention. So all I'm telling, what we are doing for window closure or a Reg 30, similarly, we can modify it a little bit. Depending on the transaction, we could probably have that relevant materiality threshold. That's my submission.
Okay. Yes, sir. What is your view on this? Because this is the most important point, and this is the industry's biggest demand. Because you have a experience, you have done this. So the proposal which they have given, it is solving problem, or it is because it's time to dil mange more and you can ask more.
Basically the regulations are intended to provide protection to the investors ultimately. Therefore, any scale-based or a flat threshold-based regulation is only a half measure of protection, in my opinion, because nothing can protect everything, and everything cannot be protected by something. Two
Okay.
sentences I am making very carefully. Nothing can protect everything. Everything cannot protect. Everything can protect only something can be protected. This has to be remembered. So far as threshold regulations are concerned, for example, 30,000 crore, let us say the turnover consolidated, and we are talking about 2,500 crore is the new threshold limit instead of this 1,000 crore. The 2,500 crore could be 100% of the profit after tax of the company. So if there is a problem with respect to a material RPT of 2,500 crore or less than that, there could be a straight hit in the PAT because of the protection that we are providing to less than 2,500, not requiring shareholder approval. So I would definitely prefer a scientifically relative to turnover as well as PAT. Then only their protection will be at least little more precautionary, and prevention is better than the cure. For example, if you take 30,000 crore turnover company and its net profits are, let us say, about 8%, it is 2,400 crore. So in a transaction of 2,500, the first 20% is the profits. We are going to be, removing something like that, which is a very big amount. So my first opinion is an increase in threshold is welcome. Absolute threshold is welcome, but 5,000 crore is definitely, if it is not linked to the profits of the company, at the end of the day, if your profit itself is 2,500 crore and even 5,000 crore transaction goes without shareholder approval, without materiality threshold, and without materiality related the regulatory obligations, I feel that it will be not good, in my opinion. Therefore, relate it with PAT up to 20% of the PAT. It cannot be more than 20%. So 5,000 crore could be there. However, a third criteria of 20% PAT probably will help us based on the last previously audited financial statement. The other point already Narayan Shankar has explained: sale or disposal of undertaking, share, subsidiary, investment, etc. That should be linked to net worth criteria also. That's all from my side. Thank you.
Amit, you have any view?
Are what Narayan Shankar has stated. I'm in agreement with the proposal that we need to have a multi-pronged threshold for testing the materiality. These tests are based standalone on the turnover basis, so may not be appropriate either way. Maybe either for protection or for over regulation. From both ends, they may be damaging. I have one more point for consideration, which may be passed on to SEBI. While we have taken care of the interest of large company, when I'm saying large means the companies who have turnover exceeding 10,000 crores, their interest has been protected. In a way, the provisions have been diluted to some extent. can we think of something on the similar line, scale base, for the companies which are SME based, SME listed, or the companies where which are listed on the main board, but the turnover is specifically on the quite lower side? So can we have a slab system over there also, so that and we can also add one more parameter while reducing the limit. Maybe we can say all transactions which have a, let's say, threshold minimum of X amount will be not be requiring any approval of shareholders under regulation 23(4). We can add one more test, provided they pass the test of ordinary course of business and arm length. Because now each and every transaction in any case as per industry standard is requiring the arm length test in any which case. If the transaction is up to that value and it is also passing the ordinary course, if it is extraordinary transaction, it should come for shareholder approval, no doubt about that. But if the value is less and it is an ordinary course and arm length, maybe a limit can be considered and the exemption may be considered by the SEBI. That's only suggestion from my side.
Okay, Amit. Okay. So I think the suggestion which Narayan is Ravi is or Amit is suggesting, let's Ankit compile it and then we can give. You have any other point, Ankit, to go before going to the next slides?
No, I think we have sufficiently discussed. Definitely, I think in your discussions also we have came across this point that turnover should not be the only criteria, but this is how SEBI intends to do it. But yes, a net asset criteria and both a comparative would definitely add some value.
Okay. ठीक. Okay, next slide, Ankit.
So now we will be discussing the material RPTs undertaken by the subsidiaries. So if today the subsidiary enters into RPTs exceeding 10% of its standalone turnover, it needs prior approval of the listed entities audit committee. This is how RPT entered by subsidiaries are governed under regulation 23. So there was some issues arising where SEBI also found out that there will be a case that where it may breach the 10% consolidated turnover limit of material RPTs, but may not trigger the standalone turnover limit of 10%, where it requires the approval of audit committee. Like for example, they have given example where standalone turnover was 28,000. So and the above materiality threshold 2,500 crore needs shareholders approval, and below 10%, 2,800 crore is no audit committee approval. So for example, if the transaction is around 2,600 crore and the listed entity's materiality threshold limit is 2,500 crore, so it will go to the shareholders approval in terms of the material party transaction requirement. But since it is less than 10% of the standalone turnover of the subsidiary itself, the requirement of audit committee approval was not triggering. So there is a little dichotomy in terms of the how you are looking into the scenario where there is a requirement of seeking a shareholders approval being a material related party. But on the other hand, the requirement of seeking the approval of audit committee is not rising because of the fact that it is less than 10% of the standalone subsidiary turnover. While a very normal solution would be that all material related parties should be approved by the audit committee, then it would solve the problem irrespective of coming with this consultation paper and outlining new thresholds. Then the another challenge that the SEBI also found out that there are subsidiaries which are recently incorporated and they have no statutory turnover because the 1 year has not been completed. Therefore, the 10% turnover rule is the companies are finding it hard to apply it, and therefore difficult to ascertain whether we would be requiring approval of the audit committee or not. So then to consider this situation, they have given two proposals. So for subsidiaries which have established track record, means having full complete 1 year financial records, and prior audit committee approval is needed if the value exceeds lower of 10% annual turnover or listed entities material threshold, whichever is lower, then the prior approval of audit committee is required for RPTs 1 crore or more. So this is the first proposal where exceeding 1 crore, the approval is required. This is the material RPT limit or 10% of the standalone turnover, whichever is lower.
Okay. Yeah,
So minimum value of RPT has also been, I believe, given, which was not there earlier.
So Ankit, let's go to the first this question. So KSR, so what is your view on this? Do you agree with this subsidiary threshold, or you want to change something?
No, this example which they have given, if that is the kind of problem we want to solve, it is easy to say that wherever shareholder approval is needed, audit committee approval is mandatory irrespective of this threshold difference
Yes, that is what I
between
mentioned.
standalone and consolidation. It's a
Okay.
simple way of dealing with it is my suggestion. Secondly, if you look at this, the net worth criteria which they have said, no, 10% of
Sir,
the
net worth is for the, we'll discuss it and the another proposal.
fine, that's all.
Okay.
Okay, Narayan.
No, I agree with KSR. Nothing more from my side.
Okay, Amit, you have any view suggestion?
No, nothing as such on this point.
Okay, and I request all the delegates or participants, please write your questions if you have any suggestion, because there is a possibility what you are suggesting may be accepted by SEBI, may not be accepted, but the experts sitting here, they can tell the correct position, so it will be useful. So please write down your queries if you have.
So I
Yeah.
think Pawan Savitri has also joined. If she has any comments on this, I think we should ask her. Definitely.
Savitri,
So, yeah, no, I've been there on this particular point. I certainly have a comment. This particular proposal, if you look at it, it does not change the current position at all.
okay.
So let's assume there is a subsidiary which has not completed 1 full year of functioning, or even if it has completed 1 full year of functioning, it does not have a very high turnover, standalone turnover. Then what we presently have is exactly what continues. My suggestion would be, if it is anyways consolidated, it may not be a wholly owned subsidiary, because if it's a wholly owned subsidiary transacting with the holdco, then you would anyways not be required to take it to the audit committee of the listed company, because it enjoys an exemption under regulation 23(5). Now let's assume this particular subsidiary, which is not a wholly owned subsidiary, is transacting with another subsidiary, maybe a wholly owned subsidiary also. Taking a 10% standalone limit of a company which is anyways getting consolidated would be a very small figure. Here maybe a slightly higher percentage could be considered, especially if it is getting consolidated and the transaction is in the ordinary course of business and on arm's length basis, because this doesn't change anything, does not change the position. Of course, the only negative point which has got covered in this, rightly so, is 10% of standalone turnover or materiality threshold, which basically means the purpose is to bring into the fold entities where the listed entities materiality threshold is lower than the materiality threshold of the subsidiary. That's all from my end.
No, though, Pawan, I think important point raised by Savitri. What we could probably consider that, of which are the items of the subsidiary which is coming into the holding company, correct? So
Yeah.
when we are talking about 10% of the standalone turnover of the subsidiary, we should keep some de minimis there also, to say that up to say 10 crores. I'm just giving a figure without any real basis. Up to some amount at least should get exempt, correct? Otherwise, like Savitri was mentioning, even small value transaction would come.
So
Okay.
I think we could look at it in two buckets. One is what is also being clearly provided in this concept note, where it says that where the where the subsidiary has a track record. And the second example goes to, which is what we'll be covering in a bit, of companies which do not have a track record. Here, the subsidiary has a track record which is far better than that of the holdco. Now, even if the subsidiary is new and does not have a turnover, and where the transaction does not exceed the materiality threshold, we should be creating a separate bucket.
Okay.
That's exactly what I'm trying to say.
Okay.
Okay. So, Amit, you have any view what Savitri has suggested?
No, I think that's a valid concern as far as the industry is concerned. Industry is struggling on this point as far as this 10% subsidiaries standalone turnover is concerned. The time from, I think, from 1st April 2023, when this threshold was changed to 10% of the subsidiaries standalone turnover, there has been debate in the industry, and there has been voice raised on this particular point. I think what Savitri ma'am has explained out in one particular situation, I think that should be considered, because at least that solves the problem of that particular bucket. So that's a valid suggestion.
Okay. Okay. So, Savitri, because you have come on a second question, in the first question we have discussed about the threshold. So, you have any view on threshold of the of this? Because now they have changed to they have given categorize and done this. So,
That's right, yeah.
Yeah.
So on this, I'm happy with the scale-based threshold being introduced. Of course, one would also always say that the three categories, could it have been more or not, but I will not go into those details. But in terms of SMEs, which Amit was mentioning towards the end, I would probably say that if you look at the categorization which has been given in the concept paper at page 4, it has shown that more than 50% of the transactions at the higher side are by large companies which have been placed for approval by the shareholders. So if you also look at the proxy advisory's recommendation, most cases it has been for, which is a good thing, of course. So, having said that, it's possibly the other ones, not the top 100, where the focus needs to be a little more. At least that's what the tables tend to show. Having said that, I would say that a scale based one is quite okay. And in terms of introducing a further threshold in terms of 20% of net profit, which KSR was mentioning, I think a little more of work needs to be done to see as to how exactly it pans out. And maybe a plain and simple one of just turnover is simple to implement, is what I would say.
Okay. Okay. Okay.
So
Ankit,
we'll go to the next proposal where they are talking about, sir, anything you want to?
no, ठीक है. You next question.
Okay, subsidiaries where they are not having a full financial year. So in order to track their annual turnover, so for them they have given a lower of two criterias. Turnover has been replaced by net worth, and the material RPT threshold continues to be there. The net worth should not be based on data which is more than 3 months old. So if you are doing a transaction, the net worth data should not be more than 3 months old. So here they have changed from the turnover to net worth, and the materiality RPT threshold continues to remain the same. And in case you have a negative net worth, then paid up capital and securities premium aggregate can be used. So this will definitely give some sort of things to work upon in case where there is no financial statements available. Currently, most of the many companies are all taking all transactions approved by the audit committee in absence of the um, annual turnover. Now they would have something to rely upon to decide what transactions to take upon. Net worth, because I think at this point of time, net worth would be the only thing where one can have some set of financial data which can also be certified and can also be relied upon. ma'am and
Okay.
sirs can also add on.
Kesar, I will start with you. This subsidiary negative net worth, so they are saying you use paid up capital with security premium. Suppose some company, they don't have security premium. And I
Only paid up.
Huh?
Only paid up
Only
then.
paid up.
Yeah. So only paid up capital will be there. Yeah, your point.
See, when we are talking about a negative net worth company, and we are talking about not older than 3 months prior to the date of prior approval seeking from the audit committee, it would be useful to say any fresh infusion of capital in the last 3 months or 6 months or 1 year, some period can be provided instead of saying a negative net worth company, but a historical paid up capital and securities premium, which is written as not older than 3 months means, for 3 months before one date we take. That also may be a historical capital which is eroded by, that is why it is called negative net worth. So my suggestion in this case will be net worth of the subsidiary as determined by the value of the fresh capital infusion, including securities premium thereto in the preceding 12 months. That's all my suggestion. Thank you.
So, Narayan, Savitri, or
No, nothing from my side. This is fine.
Savitri, any point in this? Any situation, any things you can visualize?
So this negative net worth, this particular point is a very good addition by SEBI, I would say, because in case of a company which is acquired through IBC, this 3 months, not more than 3 months, will be a good point to start with. Otherwise, typically the company would have a negative net worth. So, how exactly should the transaction be considered? Where you will just take the paid up capital and securities premium. Securities premium, of course, I don't think there would be any. But having said that, I would say that this will definitely come in use. It's a good addition.
Okay, Amit.
I certainly agree. As Ankit was saying, industry was demanding for solution for such a situation where they don't have a track record in terms of financial data and the net worth was negative. So I think the suggestion that SEBI has thrown for consideration, I think that is what, and I don't have anything negative,
Okay,
though there
okay.
may be some challenges in some specific cases, but I think it is okay.
But this is a good suggestion because
Good
they have
suggestion.
visualized the other things, and that's why they brought up. KSR, you till just before you want to leave, just 5 minutes before you just raise your hands, I'll ask your comments on overall issue. Okay, then you can go. So next, Ankit.
Okay. So now coming to RPT industry standards, they have also advised some relaxation in their applicability. So currently, all transactions which are beyond 1 crore rupees, individually or in aggregate, will require approval. Will require to follow the standards issued by SEBI in terms of the information to be disclosed to the audit committee and the shareholders. So SEBI has received some suggestions from the industry body highlighting that 1 crore is a too low limit for large companies and they tend to cover a large number of transactions and accordingly large number of disclosures will be required. So considering the issues raised by the bodies, there is a proposal to change this with lower of 1% of the annual consolidated turnover of the listed entity or 10 crore. However, the threshold of rupees 1 crore shall continue to apply.
Okay. So, now I think Savitri, Narayan, because this was the point of the industry. So they have clarified two things. One is 1 crore will always be there because sometimes what is happening, suppose company has a 70 crore turnover So 1% is 70 lakh. Okay. So whichever is lower, that is also affecting. So now they are saying whichever lower, even it is mentioned, but it should be not less than 1 crore. I think this is suggestion
I
which,
have no further in this particular proposal. It is very good. I welcome the same.
yeah. So if everybody agreeing on this, can we move on next point?
Absolutely.
So
Savitri,
only point,
your
yeah.
Dil Mange More something.
No, no, Dil Mange More. So, this is certainly a welcome move. And if you see the rationale that has been applied is 1% of annual consolidated. For materiality threshold, it is 10%. And here, this is 1%, rightly so, or 10 crores. 10 crores is because it has been linked to 1,000 crores. Now that 1,000 crores has been increased to 5,000 crores, this also, similar to the scale based, should move up to 50 crores based on the scales. So that's exactly what I would say. And
And
1 crore will continue, which means B and C will
yeah.
not be applicable of the industry standard note, but A will apply. In case of large companies, that is the way it will apply, is what I would submit.
So
Okay.
Savitri, you're linking it to that material thresholds of shareholders. And you're
That's
saying
correct.
here also we could probably give a push from here from 10
Precisely.
crores upwards, correct?
Absolutely. Because
Yeah.
materiality today is 1,000. If it moves up to 5,000, this 1% corresponding limit from 10 goes to 50 crores, linking it to 5,000 crores.
Yeah. And Pawan and others, there were many comments which I have seen in many places where people are saying that this is too lenient, etc. And they were giving examples of suppose there is a strategic sale, correct? Or of a factory or disposal of land, assignment of customer contract or intellectual properties or preferential rights or if there is any shareholder agreements. My only answer is there are many other provisions in LODR where there are enough checks and balances to deal with it. This is not they are linking it with this disclosure standard, which may not be appropriate. That's my only submission which I'm giving, because there were some places where people have made comments that, you could go ahead and sell your factory or plant that is critical to production capacity. But if you're doing sale of undertaking out there are other provisions in LODR which is going to take care, correct? Similarly, the question was, if there are shareholder agreements giving related party board nomination, there are other provision which takes care of it. There is 31B special class, correct? I don't think there is anything over here. It is in the right step is what I feel.
Okay. 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 So Amit, I think you are agreeing on this. Ankit, next.
Okay.
No, the only one
Yeah.
addition which I will want to submit for all, while we are increasing whatever is it, the amount over here, which we are increasing it, I will just say if the option is open for us to give suggestion anyway, we are relooking at RPT, correct? I think even 23(2)(f), which talks of ratification, correct? There also there is a very small threshold of 1 crore, correct? I think the same logic of 1% or 10 crores should apply there also, equally.
Okay. Okay. Ankit, next.
So they have outlined the illustration which we've already dealt. So this is how it will look like after the changes. Materiality
So
RPT
you want to show that whatever.
post the changes
Okay.
in the RPT standard, how the transactions will be applicable.
Okay.
So exceeding 1%
So
or
KSR, now you tell that this is the final scenario which will emerge now. So on that basis, what tweaking should take place? I think go back. What other things? Savitri, you also just see this is the final thing. Whatever you have suggested, any other thing which is missed, we can write to SEBI. Narayan, yeah.
One or two points which I can add is that when we are talking of net worth, correct, or any other, and it need not really be last year, it has to be up to the last quarter. correct? That will be a more realistic net worth basis. And many a times here also there is a requirement of certification by a chartered accountant. I think it is a simple exercise of paid up capital security premium, correct? I don't think that this warrants certification. We could really, if we are talking of ease of doing business, we said we should even get or internal certification is more than enough, is what I feel.
Okay. Okay. Amit,
Yeah, I don't have anything
Okay,
further
Ankit.
on this RPT.
move on.
Now coming to the omnibus approval, I think what is there in terms of the
Sorry,
circulars that
Ankit, one point. We probably, are you going to touch it separately that if it is below, then you have to go as per annexure 2 of the consultation paper. That is covered or it is yet to be covered?
sir,
That will
what
get covered in the earlier point, correct?
yes.
So there my only point is because here you're now creating a separate threshold of saying that for small value transaction, that is if it is up to 1% or 10 crore, correct? Now you have to follow the annexure 2, which is virtually the same which was there earlier in that annexure 3B, para 4 and 6. Only one point we could probably suggest is if there are anyway small value transaction, leave it to the audit committee for ease of doing business. No need of having a separate annexure in a and again having companies to look beyond, because even when we came with the industry standard forum note, we said that there should only be one document which people should see as far as RPT is concerned. So either completely do away, there should not be any annexure for this de minimis clause, or at best include it in the same ISF if SEBI doesn't agree, so that there is a single point reference. So if you recollect, Savitri, we had the same approach we had taken even for high value debt listed entities, where we said instead of cross referencing, if you only have debt, only the chapter, I think 5A or that only should apply, correct? There's no need of having multiple reference points. Similar to that.
Sure.
Okay.
So coming on to the validity of omnibus approval. So I think in previous circulars that SEBI issued and then it merged with the master circular, they have outlined the validity period of omnibus approvals when they are approved in AGM and otherwise. They are only now trying to bring that as part of the regulatory regime by amending the regulation 23. But there are always some chatters around how the omnibus approvals in shareholders work, whether they, in terms of the periodicity, in terms of approvals, whether there is a concept of omnibus approval in case of shareholders or not. So we can discuss around that. I believe Narayan Shah has some views on that as to how omnibus approvals should be dealt in terms of shareholders approval. And then ma'am and Amit sir and
Yeah, sorry, Ankit, you were referring to me?
yeah. So sir, you I believe we also had some discussions around this on omnibus approvals being subject to getting shareholders approval in terms of their periodicity.
Yeah. So that there were 2 points which I wanted to make a mention. Because of that SEBI circular, one thing which probably the proxy advisors and other were taking a call that everything going from the company should be restricted to a 1 year period. Otherwise, they were recommending voting against, correct? My only submission is you can have specific contracts. For example, if it is a power purchase agreement, or if it is an automotive company, you want assured supply of engines. You will not be setting an engine facility for 1 year or a power plant for 1 year, correct? It will go to 5 years, 10 years. So specific contracts will be guided by the specific agreements in that clause. And if required, we should get a clarification. If since we are talking about validity of omnibus approvals, probably we should also ensure that multi-year specific contracts will be guided by those contracts. And if it can also be clarified that existing shareholder approval, if it is for multi-year related party, they will equally remain valid as originally envisaged, correct? This too will go a long way in creating a doubt which is there in some fraternity that anything beyond 1 year is probably not a good thing to do.
Ma'am, any views?
I fully agree with what was mentioned by Narayan Shankar. See, I think we need to take a step back and look at this word omnibus approval. The term omnibus approval has been used in 23.3 of LODR in the context of in the context of something where you don't know the name of the party, don't have terms and conditions known to you, and in another it is said where the transaction is repetitive in nature, which is in sync with rule 6a of chapter 12 rules. Now the purpose was to facilitate transactions, but in some way if you're going to restrict it in terms of a tenure, you are then saying that you're going to put a stopper, saying that these have to go back to the shareholders on a yearly basis. Narayan Shankar has very rightly taken the example of a power purchase agreement. You know, for reasons of commercial sensitivity, a company may have a power purchase agreement which may be long term. It will be for a period of 20 years, 25 years, as the case may be. And you're saying, I need to go back to the shareholders on a year basis, will not work. Now, does it mean that a very simple solution of having a carve out for power purchase agreement will work? Answer is no. There are several such agreements. Let's say, I was once asked by a person in one of the seminars, if I have a joint venture agreement and the two parties to the joint venture have agreed that they will support the other entity, they will support this joint venture entity, which obviously becomes a related party transaction, then for every purchase, do I need to go to the shareholders on a year basis? Or if I put it in the articles of association, will it cover it forever? Now, the very purpose for which you've formed this joint venture is to be able to work together, have the synergies. That gets defeated if you're going to the shareholders on a year basis. Now, the question here is, if there is certainty around a transaction, once you've taken an approval, if at all it requires shareholder approval, that should actually run the tenure. You cannot expect it to go time and again to the shareholders for their approval, because we have these guardrails to support business, and it should therefore enable it.
Yeah. And one more thing, I think people are all missing the objective for which this omnibus was introduced. What was the objective? If you look back, the objective was if omnibus approval given by audit committee is for a financial year. The question raised by industry was, in case if you're giving omnibus, the period between 1st April to say the date of the AGM was open-ended. So many companies had gone to SEBI and said, then you will have to again go to the shareholders for that broken period. Hence, to address that, SEBI said that, okay, we will agree it is from one AGM to other AGM so that you don't have to go in between for a postal ballot. That unfortunately has been misinterpreted to say that you cannot have, by some people, that you can't have any approval of related party beyond a year. All I'm wanting to say, if the companies have got specific agreement, I said like for power purchase, engine purchase, if it is for a 5-year contract, the approval of the shareholder will also be equally for 5 years. Otherwise, the person setting up the plant will not be comfortable that every year he has to just be wondering whether the resolution gets passed, and depending on that, he's going to put in, he's already put in money, correct? That was the point. Thank you.
Amit, your view?
So I think point that is coming up for discussion is not because that there is any gap in the legal framework. This is all because the proxy advisory firms have been giving against voting in such kind of scenario, A. And in certain scenarios, in certain cases, even SEBI has inquired into the related party transactions where shareholder have given approval for period exceeding 1 year, right? In those few scenarios, this discussion, what Narayan sir and Savitri ma'am has done, is based on. Legally, what is written in the 23.3 framework and in the circular, even which was issued later on, I don't think there is any gap. We must understand, as rightly put by Shankar sir and Savitri ma'am, the commercial transaction needs to be looked into from the commercial perspective. If we are not able to look it and evaluate from the commercial perspective, the business will go off for the toss. It is to facilitate the business. It is not to other way stop the doing of the business. If a like example Shankar sir was giving for the power purchase or for any continuous supply agreement, the way proxy advisory firms have been interpreting is like you have no option but to agree only for a year, and then again year on year basis you have to go for the shareholder approval. I don't think that is the right approach. Fixed term contract will be out of the radar of the omnibus restriction for 1 year shareholder approval. No change is required, but good if some clarification can be inserted in this particular regulation so that this doubt from the minds of the proxy advisory goes off.
So let me just give a very simple example here. Power purchase is always understood by everybody, but let's take a mall. And in the mall, let's assume there's an anchor tenant who has been given, and the anchor tenant is a related party. You have given the anchor tenant a particular rent, quoted a particular rent, and let's assume the total amount exceeds a materiality threshold. If you go by this of one AGM to another AGM, you're saying that while the agreement to operate from that particular premises, maybe for a period of 5 years, every year you need to go to the shareholders, which cannot be, because for any kind of concessionaire agreement or any kind of payback where you have other holders in the entity also, you would want some kind of certainty. What if the tenant says, very good, I'm getting a cheaper place, let me come out of it? That is also possible.
Yeah, absolutely. It is not commercially viable.
Yeah.
So we'll try to create some suggestions around it, sir, and then share it with SEBI,
Yes.
highlighting the concerns and what kind of clarification we can expect from them. So moving along.
See, omnibus is one where you don't know who you're dealing with, what you're doing, there is no agreement. Those are omnibus, not otherwise. The specific agreements, specific transactions cannot be called omnibus.
Sure, ma'am. Now, with respect to the definition of RPT, there is an exemption under the definition which was also recently introduced, that retail purchases by directors and employees from the listed entity and subsidiary on uniform term will not be considered as an RPT. So SEBI has suggested some things, that employees are generally not related parties. So there is no need of employing that exemption. So it is proposed to remove the exemption. And then it is also proposed to cover KMPs and then their relatives as part of the exemption. So directors, KMPs, and then their relatives will, any transaction that they undertake not in a uniform terms as appearing or offered to all other customers, then they would not be considered as RPT. I think it's a clarification and a welcome change. So I don't think any much. Ma'am, anything you want to add? Is there anything?
No, Ankit, Savitri, you remember that there is always, when we were discussing, everybody is talking about that I'm in the company and I'm using company service and things,
Correct.
what I will do, or salary of the directors and other thing. So I think this is the right time that this issue should be clear, that these are the things are not applicable in RPT and rest of the thing is coming in RPT. So the exception clause should be very, very clearly defined.
Absolutely. Say, for example, it is very common. What should also get covered in this is, it is very common for employees of the holdco to hold directorships in the subsidiaries.
Yeah.
If they get sitting fees in the subsidiaries, it will not be a related party, has now been clarified. Now, while it will not be treated as a related party transaction, it will not require approval. Will the disclosure under 23(9) require this to be disclosed? Presently, I don't think in 21ZC there's a carve out, because this is covered in 23 and not in 21ZC. Narayan
Ma'am, for
Shankar?
remuneration and other things, there is a carve out.
Hmm.
For remuneration and other things for the employees and directors, there is a carve out in the
No.
disclosures also.
No, that is with respect to the remuneration.
Yes, ma'am.
I'm
Not
saying
with
let's assume Mr. A is an employee of the holdco and he is getting sitting fees in another subsidiary. Will the disclosure requirement apply? Presently, companies just put it on the 21ZC. Is there a carve out saying it will not be a related party transaction requiring disclosure? If it is
no,
covered in 21ZC, it will get ousted.
yeah, it is not covered in 21ZC, ma'am.
Right.
It is there is a separate provision on the remuneration also under Regulation 23. They have not
23.
provided
23
that.
is only for approvals.
Yes.
If it is covered in 21ZC, if it is not covered in 21ZC, then it is a related party transaction, just that approval is not required.
Yes.
And it may be good to just, it's a small technicality, but it will be good to include it.
No, but
Narayan
Ankit,
Shankar?
I agree with Savitri. There
Yeah.
is no harm clarifying even
Correct.
under 23(9). Otherwise,
Correct.
what you're not taking to the audit committee, why will you disclose to
Definitely.
the public at large, correct? I
Correct.
think we can definitely clarify this.
Correct.
Sure,
Other
sir.
than that, no, nothing at all.
Yeah.
And I think the last is with respect to the exemptions, which currently talks about RPTs entered into between holding company and its wholly owned subsidiary and between two wholly owned subsidiaries of listed holding company. So there is a proposal to clarify that this applies to a listed holding companies. So holding company is proposed to be replaced by listed holding company.
Yeah, basically, this would mean
Yeah.
that it's actually, this is exactly the way companies have also interpreted.
Yeah.
Although the
Anyway,
Yes.
wordings, although the wordings do raise a doubt as to whether the intermediary holdco, which is unlisted, if it deals with another wholly owned subsidiary of the intermediary holdco, will it be exempted or not? Companies have taken a conservative view and have considered it as not exempted. Having said that, since the intermediary holdco is not a wholly owned subsidiary, from a consolidation perspective, if certain kinds of transactions, should we have a carve out or not? See, if it is with respect to something which is moving out, it's a
Agreed.
different issue. Otherwise, you are going to be covering it in your consolidated financials of the intermediary holdco. So, therefore, is there room for a carve out? Maybe not an en blanc, not a carte blanche in terms of permitting everything, but certain types of transactions. Say, for example, it's a purchase and sale between those two entities.
Hmm.
It's again with the wholly owned subsidiary only. So, is there any concern area? Is something which should just be studied a little more and exemption granted if required. Although, in principle, I am in agreement with the wording being read as listed holdco.
Holding and
Now,
subsidiary.
you have this as listed holdco, but have a carve out, is my suggestion.
Sure.
Yeah. So Ankit, I think
Yes, sir.
completely agree with Savitri. And how we could address this, I'm telling you, we should just give a small explanation that for the purpose of exemption in regulation, I think it is B and C, correct? In your slide, 23.5 B and C. If you just say wholly owned subsidiary of a listed entity would include even a step down wholly owned subsidiary, correct? That is a wholly owned subsidiary of a wholly owned subsidiary. So that intermediate and everything, because the term wholly owned, so long as it is wholly owned till the 7th level also, it is single parenting all from top to bottom, it will continue to be a wholly owned subsidiary.
Yes, it will
So
be.
if that explanation, we can draft something so that this point of, Savitri can be addressed.
No. This in any case is currently addressed,
Yes.
Narayan. What
Yeah.
is not addressed is, let's assume you have a
Yeah.
listed company.
Okay.
The subsidiary is, let's say, 95% owned by you and 5% by maybe a JV partner, maybe a third party. This 95% subsidiary has a wholly owned subsidiary. This 95% subsidiary, let's assume, is supplying raw materials for the 100% subsidiary to manufacture, and the 100% subsidiary is manufacturing, marketing, doing whatever. The transaction between this 95% subsidiary and its wholly owned subsidiary is not exempted
Yes, not
currently
exempted.
also, and that's exactly what is sought to be very clearly clarified. Now, my point is, with respect to 95 dealing with its wholly owned subsidiary, can we have a carve out?
No, would be difficult, Savitri, because the moment it is not wholly owned, it's even if 95%, even if that
Yes.
5% is held by another subsidiary. Because Savitri, we've had this discussion even with the auditors and with multiple times, correct? And the one point which has come is if it is 95, even if that 5% is held by another subsidiary also, even if it is wholly owned, even then they don't take this call.
Sir, but
It
in
would
that
be a
case, shouldn't
difficult
it this
nut
be
to
a wholly
crack.
owned subsidiary?
No,
If
no,
it
no.
is,
If it is 95 and 5 by another subsidiary,
it
which
is
is a wholly
100%.
owned subsidiary,
Yes, it is 100%.
it's 100%.
No, so all I'm just saying, there is a difference in view over here, because what I'm trying to tell is, imagine if you are going to say you will have 100 wholly owned subsidiaries having one share in another company and
Yeah.
all 101st becoming a wholly owned subsidiary. It is a
Yes.
fragmented parenting, correct? I'll tell you why it is not, but not at this juncture. But I'll tell you why it is not a doable proposition. But not for right now. But right now we should just see if we could. I think we should go ahead right now. It's in the right direction. We should go ahead. Go ahead, please.
Okay. So now,
Only one point, only one point. I think time and again we have been debating on this wholly owned subsidiary issue, and this term has been creating a discussion every time we come across the views of the different professionals. Why can't we suggest to SEBI, this is the right time, at least we should make an attempt to define this term precisely, what is the wholly owned subsidiary in terms of, so that we are also, because we can avoid the conflicts among the professionals also and in the industry also. That will.
okay. Now, I think we have covered this part now.
Yeah.
I will just take 2-3 questions, and then Savitri, Narayan, Amit, please tell us that what is still missing so we can make a complete proposal to SEBI. And Savitri, I will request you and Narayan Shankar, the issue of other item like these setting fees and the purchasing of the goods using services, that should be carved out clearly, because you discuss each and everything in our ISF also. This issue
Yeah.
is coming and again and again. So that SEBI should give clearly this particular clarity in this message. Okay. So now, Savitri, there's one question. Can RPT be more than 100% of turnover of the entity?
There is no problem. There is no legal bar in it being more than 100% of the turnover. It's quite possible it's a new subsidiary which is going to start its business, going to expand, and therefore the turnover presently is not very large. So it's quite possible.
Okay. Any other view in this?
So long as you have a proper rationale, there is absolutely no problem.
Okay.
Are you referring to the turnover of the listed entity? Then there is a big problem.
Okay. So turnover of subsidiary, no issue. But the turnover of the listed company, what is the issue in this?
So actually, the listed entity is doing X amount of turnover today, and you are then saying that it's going to be doing 2x or 3x as the case may be, which doesn't really appear to be business-wise a thing which will be sustained. So, which is exactly the reason why the shareholders will have lot many more questions.
Okay, Amit. You are laughing.
But no. I'm saying the same example what Savitri ma'am was giving for the subsidiary. That could be the case for a holding company also. Say my turnover is 100 crore, and next year I have got a supply order for 500 crore, and I have to procure another 200 crore from my related party. Then only I will be able to supply 500 crore goods. So I don't see, as long as we are able to have a rationale, as you rightly mentioned, I don't see should there be any problem, even if it is the case of a holding company.
Okay.
Yeah, but also there'll be corresponding capex. If you're saying that, yeah. So, all those justification will have, one can always say that, yes, I have created the capacity and I was not able to use my capacity. Suddenly I've got this order, which is a government order, and I'm going to be ramping up. No problem.
Yeah, absolutely.
Okay. Savitri, next question. Is it right benchmark to compare balance sheet item with P&L item? That is,
It's a very, very theoretically technical question, and I would refrain from answering. But if there are specific heads which one is asking, I would be able to throw more light on it.
Oh, so then
However, having said all this,
Yeah.
if it is a question of the threshold which is linked to the balance, which is linked to the profit and loss, while your transaction may be relating to something which is a balance sheet item, I would say that the P&L shows a general idea, and most companies would have a turnover. So, of course, there are certain cases where you don't have very high turnover, which is the reason now they are saying with respect to subsidiaries, you can look at net worth. But having said that, typically this is a good way to start, and hence you are using the threshold of the consolidated turnover.
Okay. Savitri, the example is also there. Company A listed NBFC borrows in its ordinary course of business from Company B private NBFC, both being related party, which is more than 10% of its consolidated turnover.
Sorry, please come again.
Oh, Pawan, what I'm trying to tell, we had addressed this in the beginning itself, but I had addressed that if you have transactions like investment, assets, guarantees, all and many other transactions which are balance sheet based, correct? Instead of turnover, what is the other materiality benchmark, correct? We talked about net worth, total assets, correct? We've already addressed this, I thought.
No, that is right. But the question which somebody is asking,
Yeah.
is it right benchmark to compare balance sheet item with P&L? Example, Company A listed NBFC borrows in its ordinary course of business from Company B private NBFC, both being related party, which is more than 10% to its consolidated turnover. That is the question.
Yeah, this is the difficulty, sir. I completely understand from where the person has asked this question. As Ravi Chandran sir has also indicated in the beginning, and Savitri ma'am has tried to answer. See, SEBI cannot give a benchmark which is appropriate for all situations. Perhaps turnover is the easiest benchmark to frame the general regulation for the industry.
Okay.
Uh, it is not that it is the best benchmark as far as the balance sheet item are concerned. It will add to more complexities, as Narayan sir has also indicated that there should be multi-pronged approach as far as the thresholds are concerned. Maybe in times to come, we have the little differential approach with regard to the balance sheet item, and then the problem can be sorted. But yes, this is a problem. I am in understanding.
But Pawan, what I'm telling, there is already a clarification, what we discussed in the beginning itself, that even there is clear guidance, even under Reg 30 as materiality, correct? Where relevant benchmarks, whether it is net worth, assets, etc., will have to be matched with that. So all I'm wanting to tell is our suggestion could definitely be that it needs to be multi-metric and transaction specific, correct?
Okay.
Yeah, if it is investment, it has to be percentage of net worth or total asset.
Okay. Okay.
So
Yeah,
that
this
anyway,
question is
that
more
column-wise multi-metric, I'll also try to prepare and send it to Ankit. Okay?
Okay. Okay.
Okay.
Two comments are there. Do not suspect management. Sufficient verify with competitive product open market price. Practically, shareholders' approval need not be considered. Only management board approval made applicable. This is the view some of the participant has given. Okay, now I will start, Savitri, with you. What are other changes which are pain point of industry, professional, and growth? So in RPT, because this consultative paper is not, they are giving some very specific point, but when they will change it, they can change it anything. Okay. So now you have a ISF standard also. You have this changes also, which was the demand of the industry. Now I have suggested, or we have discussed this point, that some exceptions clause should also be clearly mentioned so people will not confuse. And in the standard also, we have given the complete picture of all types of transactions, which is a part of the standard. Now, what are other issues which say we should consider and we should write to SAT?
Sir, I have just one more point before Savitri ma'am address, and I'll flag this point for her to address in her submission as well. Consultation paper at the end, where they have given the text of draft regulation. If we see regulation 23(1) proviso, they have changed the language from provided that a transaction with related party shall be considered material. Now they are saying provided that related party transactions with a related party shall be considered material. So now the debate that we had, I think in couple of forums where, because related party term is a defined term in regulation 21ZC, and the transaction related party was not a defined term. So one school of thought was that it is only and only those transactions where listed entity is the party will be requiring the shareholder approval in terms of regulation 23(4).
Okay.
Now, because they have made this change, though it has not been talked about anywhere in the consultation paper, but this is a change which is appearing in the regulation, the proposed regulation. Do you see that is there any change in the legal framework in application? That means earlier the transactions with subsidiaries where listed entity was not a party were not required to take the approval of shareholder, and now these transactions will come into approval, or anything else? What is the implication of that change?
Okay. Now, Savitri, you give answer of Amit question and your own comments also on this.
Sure. So, Amit, you've raised a very valid point in terms of what should require shareholders' approval. If the listed entity is not a party to the transaction, should it require approval at all or not? That's a very fundamental question. However, from a group perspective, the regulators feel that it should not just be the listed entity, but transactions of the subsidiaries also. There are difficulties where the subsidiaries, while from a accounting standard perspective, you may be in control of the subsidiary, the subsidiary may not be 100% subsidiary of yours. So therefore, all these transactions requiring approval may pose a challenge. However, that is the law, because there have been certain transgressions because of which the law mandates it. It's difficult but not impossible, and therefore that's the way the well-governed companies have always complied with it. I don't really see that as a major issue, and I would say that I don't think that's really going to change, and I'm okay with it. Coming back to points which would require, I'm going to confine myself only to RPT because the discussion is on RPT. There are two specific points, and these are pretty low hanging fruits, and hence I'm going to be speaking about it. One is, if you refer to the original circular of November 2021, under which this format in 23(9) was introduced, it very clearly stated that transactions between wholly owned subsidiaries or the listed entity and its wholly owned subsidiary need not be reported. So now, if you look at it, while there is an exemption under 23(5), the reporting is not exempted, which actually means the number of line items with respect to these transactions are added to the disclosure lines that you have. These, one, do not require approval of the audit committee under 23(2). Two, they are not governed by the ISN also, but with respect to reporting, they are required to be considered. This is one point which actually could be once again reviewed. The second point is what I covered a little while ago with respect to employees of the holdco being on the board. If at all there is a sitting fees that is paid, that should also not be considered as remuneration and should not be brought into the purview. And those are also not transactions. If you bring it out in 23, if you bring it out in 21ZC, then it will automatically not require any disclosure in 23(9). Because if it is covered in related party, then one needs to test it against 23. But if it is not covered in 21ZC, it goes out of the reckoning from a RPT definition perspective. Narayan Shankar?
Yeah, no, so first just wanted to address the point raised by Amit. So, Amit, I don't think what you're telling really would really be you're trying to dissect two small things of saying a transaction with a related party with a related party transaction. And that you're doing because the language in 21ZC is a related party transaction. Would I be right? That was your point?
Yes,
What I'm telling, that is
yes.
any the case even now. What I'm trying to tell you, if you see the provision to 23(1), they don't use the word related party transaction. They still use a transaction with a related party. But that
No,
when
no,
you
they have
use
amended.
it, 1 minute, please. But no, but the provision of 23(1) is still same. Where there is amendment?
No, there is a proposal. Now they have changed, provided that related party transactions with a related party shall be considered material.
I am
That
telling
is
that
a
is the
change.
case even now. Right now also there is the same language in 23(1). There's no change. You just go through it. But 23(4) talks of material related party transaction, correct? All material related party. So it has to be read together. All I'm wanting to tell, there is nothing major difference over there. That's my only. And for other points, Pavan, Savitri, we discussed whatever Savitri is told about 23(9), definitely sitting fees, commission. We spoke that net worth could be quarter ended and not last year. We spoke about CA certificate really not really required for net worth and others because it is just a simple calculation, correct? And we also made a mention that for small value transaction, which they have carved out, instead of having a separate annexure in the consultation paper or in the LODR, either exempted completely and don't have anything equivalent to that part schedule 3B, or at best include it in one place so that anything on disclosure is only in one single paper. People don't have to go through multiple transactions. We also spoke about whether wholly owned subsidiaries and other clarificatory things which we want. We could definitely address all that. And definitely, the way you have requested, Pavan, I and Savitri will try our best to see what help we could render to Ankit in finalizing this.
Yeah, that's right.
Sure.
This Savitri or Narayan, there is one, as per Company Act, wholly owned subsidiary also need RPT approval?
Actually, under 180A, 177(4), there is a reference where it says that it does not require approval except where the transaction is covered under 188. Now, actually, going by the spirit of what is covered in 177(4)(4) is where the transaction is not in the ordinary course of business or not on arm's length basis. Only those ones, because the proviso to 188(1) very clearly says that whatever is in the ordinary course of business and on arm's length will not require approval. However, there's another school of thought where they, to be more cautious and play conservative, they take approval if it is covered in 188(1) with respect to the nature of transaction. But going by the spirit, possibly the intention is where it is not in the ordinary course or not on arm's length basis. Because if you also refer to AOC 2, that's the spirit behind it. But in terms of drafting, maybe it could have been a little sharper. Maybe a clarification on this from MCA will be helpful, but this is the gist of it.
Okay.
Narayan?
Yeah, no, but Savitri, I agree, because Companies Act, Pawan, will always, like the way Savitri mentioned, it will be other than, even if it is wholly owned subsidiary, other than transaction mentioned in 188. So there are two ways of interpreting it, other than 1A to G or whatever it is of 188. And the second one is, anyway, 188 itself gives you exemption if it is an OCB and arm's length, everything goes out, correct? But all I'm telling, that differences will still be there because LODR does not have this concept of OCB and AL. So that difference I don't think there is any way we can't help anyway.
Correct. Absolutely.
Okay. So Narayan, your additional point?
No, I've already added, Pawan, all the points which we mentioned.
Okay.
And yeah.
Amit, yours?
I will just reiterate that we need to have a clarity with regard to, if we can bring, that is with regard to the wholly owned subsidiary A, with regard to the related party transaction. Because currently, I think we have now traveled a long journey. Now, still tagging your related party transaction to come up from the accounting standard, I think it's not correct, because majority of the transactions which are in frame of 21ZC are very clearly understood. But when it comes to the accounting standard, it is very difficult, and the always the debate between the accounts team and the secretarial team comes in between because of the subjectivity of the interpretation with regard to the accounting standard. Whatever 1 number, 2 number, 10 number you want to add, I think let us have an exhaustive definition in the LODR itself so that a complete coverage can be understood. One more point where I think at least wherever I have discussed, the industry is not having a clarity whether the approval under regulation 23(4) is transaction wise or it is entity wise. Means if let us say there is a entity ABC which is doing a transaction with its 10 subsidiaries, A1, A2, A3, A10, and say B Limited is the related party, which is for A1, A2, A3, A4, A5, A6, A10, and say it is for lease agreement transaction and the value is 1 crore. And whether A Limited has to consider put together transaction of all subsidiary because the related party remains the same, that is B Limited, or it has to be standalone. Different people are taking a different approach as far as this particular interpretation is concerned. Likewise, there could be few other areas as well. I'll try to jot down from the suggestions that we have given in the past, and I'll forward to Ankit, and maybe we can put it for compilation.
So let's do one thing, Amit. The various points which we have discussed, certain points which Savitri and Narayan and you have suggested. And third is, whatever other point is there, please give it to us, because I think 25th is the last date. So we will compile it and share it. So on Monday, I'll try to share a copy as early as possible. So when it is finalized, we can give it to the SEBI. Okay. So I think with this, we have come to the end, this program which we have done, I have already told you that always corporate world, including professional, should be proactive, not the reactive. If you are a proactive, so all these suggestions SEBI will understand and they will modify it. Once law is becoming the law, then how they will change it. So the proposed law will become law. So to change is very difficult. So that's why sometimes people wonder that when we are organizing program on consultative paper, because we have organized more than 20 programs on consultative paper when the law is coming, we want to take views from the professional and the corporate world, and then submitting to the regulator. And regulator has really done this change. Savitri Narayan was already there in IB, this PIT, and then the PIT FAQ, PIT, various things has come. In MC also, the M&A government companies we have done. IBC, we have done the same exercise, and Mr. Sahu has come on this. So this is very useful. So with this, I'm just closing this session. And before closing, I'll request 30-second of closing remark from Narayan's side, and other Narayan, Savitri, and Amit side. So I'll start with Narayan Shankar with you.
No, nothing more. I think we've discussed everything. Nothing more from my side.
Savitri.
I think it's been a good round of discussion, and this is one of those programs of yours, Pavan, where you're going to end a little early because we've had enough time for discussion on a very important topic.
Yeah.
And as usual, it's been a pleasure. Thank you.
Yeah. Amit.
Yeah, I think all I can say, I've never seen SEBI so very proactive uh, in bringing out the changes, listening the industry the way it has been in the last 1 year of time, be it industry standards or be it the again consultative paper, which is in a way amending the industry standard again. I think commendable job done by the SEBI as far as understanding the industry pain points are concerned. So a long way to go. Thank
Okay.
you.
Okay. So with this, thank you very much. We are closing this session. But as you are aware that our knowledge journey is continue, and this knowledge journey, we are the only facilitator. Savitri, Narayan, they are the top scorer, and Amit, all, and KSR, they are the top scorer and giving knowledge. So all the industry, from the side of all participants, I am grateful to all of you who are giving this knowledge and giving their time for creating value for others. It's a grateful. So हम लोग कहते हैं ना कि नॉलेज शेयर करने से ही नॉलेज बढ़ती है. That is a important concept. So we are all grateful on behalf of participant to you, Narayan, Savitri, Amit, Ankit, KSR. And with this, I'll just inform you again. The next Friday, we are having very interesting topic on fraud in securities market. And this topic, which we are covering, it is on insider trading. It is on front running. It is on various pump and dump, various research news is coming. So the topic's name is fraud in security market, Indian security market, patterns, pitfalls, and prevention. And very importantly, the ED of investigation, Mr. G. Mohan Rao, is coming, and Naveen Sharma is coming, and other speakers will also be there. So till then, good night.
Thank you very much, Pavan. This is not just about giving. I would have very humbly submit that there are a lot of learning that I have from these sessions. Thank you very much.
Thank you. Thank you.